What are you even buying? What are you even selling? Yeah. So again, in an effort to make it simple and easy to understand, just like you can buy a good, or a service, here you'll be buying different currencies for whatever they are worth. For example, now in Kenya, I think the USD may have gone to maybe one, or last time I checked was 108, but somebody told me it may have spiked to 120. I don't know. Which means if I want to buy the USD right now from Nairobi, I'll have to pay somebody at least 108, 110 Kenya shillings to get one US dollar. Okay. And vice versa, somebody coming from out and maybe they have dollars, when they come into the country, they can buy the Kenyan shilling. If they have $10, they can be given the equivalent of 10 times 108 or 110. So they'll probably have like what, 1,100, if they have $10. So again, that is the buying of currency. But now the Forex market has made it possible for us to now trade those currencies online. And that's the birth of the Forex exchange. So there are platforms that have been set up, and the platforms essentially allow you to buy and sell currencies in the Forex, in the foreign market. All right. So in these platforms, and I say today's class is very, very basic. So we won't even go to the depth that maybe most of you would be thinking, but it is a foundational information that we'll build up. So I'll be having these small classes, but will be foundational. So just as an illustration, these platforms that allow people to buy and sell currencies have some particular features, that are very common. In fact, all of them have the same features. And the features are, uh, for many of you who went to at least secondary school, you'll remember that whenever you drew like a chart, okay, you'll have the x-axis will be time. Okay, in this case for Forex, the x-axis is time, and the y-axis is money, okay, currency. So let me just put the dollar sign to show money. So basically, we're saying that in the Forex market, a lot of the buying and selling has been represented in the charts. And those charts have something like this, where the x-axis is time and the y-axis is the money. So, like I said earlier, maybe somebody has $1, and the $1 to the Kenyan shilling is about 108 or 120, depending on the rate for the day. All right. Maybe yesterday it might have been 105 or something. So if you look at this graph, you'll find that if you were to mark the currencies, okay, and again, I'm only going to use the example I gave earlier, dollar, and this is time. So you find that maybe if our time here is, today is Monday, so let's start with maybe Thursday. So Thursday, Friday, okay, and today is Monday, and tomorrow is Tuesday, and so on. So you find that maybe on Thursday it was as low as maybe 105. Okay, then it went up to maybe 106, 107. Okay, 107. Then now it's maybe at 110, the value of the currency. So if you were to draw a graph, you find that from Thursday, maybe it was there, but then it went up to 105 or 107. And then maybe it went up to 110. Now, this is just a simple graph, okay? And you can see where those things reached at. Now, why am I using a very simple illustration? Because some people don't get it. They just don't get the basic concept we're talking about. And that's why sometimes it's good to come back to the basics. So then this currency, regardless of where it was, or maybe if it came down again, and we know that sometimes Monday, maybe it's very expensive. People will tell you don't even buy on Monday. No, it will be very expensive. Okay. Then maybe by Tuesday, the value goes down. That's what will happen. You'll find that the currency keeps going up and down and so on and so on. So this idea of time, the value of that currency changing with time, is what Forex market has been made of. Okay. Only now you don't have just one currency. You have a pair of currencies. Okay. So like now, if somebody wanted to trade the pair, if it was trading maybe US dollar and Kenyan shillings, okay, unfortunately it's not being traded in the market, but some of the popular pairs, okay, so somebody will say, well, let's take the pair, assuming Kenya shilling was very popular, all right, then the pair of Kenya shillings and the US dollar would be traded. And what's the pair like? Well, you could use maybe the base currency could be Kenya, the US dollar, and then the base currency, rather the currency that's being used against the base currency is the Kenya shilling. Okay, so you find that that ratio maybe is like 1 to, again, hypothetically, let's say it's 0 for the Kenyan shilling. $1 is about 108. All right. So that's why you'll see this as being your chart. So now extend this idea to other pairs like Euro USD, the most volatile currency in the market currently. Okay. Then there are many other pairs that you can use. All right. And all these pairs use the same idea of the graph, which the horizontal is the time aspect, and the y-axis is actually the value of that currency. Now, one significant thing about the time is the time moves from left to right. In other words, right, wherever you are, the current time is always on the right. Okay? Whatever is showing up in the market on the right, that is considered the current value of that pair. Whatever you have on the left is historical information, which uh, can be useful, actually is very useful for your analysis, it's very useful for your planning and so on and so on. But at the point you're taking your trade, you don't take the trades, okay, of the past, but you take the trades, okay, as they come, when they come in the future. All right. Having mentioned that, then now I can introduce a chart. Oh, and before I introduce a chart, then the movement of currency, maybe from point A to point B, like here in the chart, if that is a point, let's call it point X. Okay. At point X, my writing, okay, X to point Y. So this is another significant thing we need to know about the movement of currencies. So that's moving from point X to point Y, of point Y to point, let's call this one point Z. All right. So if this is maybe 1, or if this is 105, this becomes 106. Okay. And up here it's 110. So we are only concerned with the change of value between X and Y, which means y minus x. Okay, that change is what we're interested in. And that change of the price from point X to point Y is what we call price interest point. Okay, the price interest point, and it has a acronym: price interest point, interest point. Oops. Anyway, you get the idea. It's actually normally referred to just as pip or pips. Okay, so the change from here to that is a pips. Whether it's going up or down, it doesn't matter. So from Y to Z, yes, you're coming down, but then we call it pips, regardless of whether you're going up or down. So this from X to Y could be, from our chart here, be 110 minus 106, where the difference is actually 4. So you can say it is 4 pips. Okay. Now that is going up. Now if you're going down, again, the idea is the same. The change of value from Y to Z. So Y is 110 and Z is 107, and the difference is 3. So that 3 is actually called 3 pips. All right. So it doesn't matter that it's going, X to Y is going up and the Y to Z is going down. It doesn't matter. The difference is what we're interested in. That's what we call pips. So pips will become very, very important, very critical as we continue. All right. So what I'll share now basically is an introduction to the charts, okay, but based on this basic understanding that we've just talked about right now. All right, and then I'll open it up for questions, and then we shall be done. So let me see if I can. Okay, I'll clear this. Okay, and then I will stop this. I'll share a chat. So there are many platforms you can use right now in the market, very many. And I'll just see if I can share one. Okay. One second. Okay, I think I have all my platforms closed. So I'm opening one. Okay, in the meantime, start preparing your questions because I'm finishing in the next 5 minutes and then we are open to questions. And this is introductory class. Very, very basic, very fundamental. That's why I'm making it short and precise. And today, the only thing I've talked about so far is what Forex is. Okay. When people buy and sell, what is happening, and generally the whole structure, okay, of a Forex chart. So let me see if I can just open one. Okay. All right. So I'm going to share right now. So like I said, there are very many platforms out there. Okay, I'm going to share one of mine that I use. Okay. And so this is the structure of a Forex chart. Okay. So it has an x-axis, which is there, and it has a y-axis. The x-axis basically tells you the time from the beginning, okay, all the way. So when you come from the left to the right, it tells you where the market has come from and where it's going. The right will always tell you what the current price is. So as you can see at the bottom here, essentially we have, let me see, we have time, okay? So those are timelines. And this time depends on the time frame you're using, all right? So there's some time frames that get very granular, okay, in terms of maybe minutes. Okay, so you see the time, but comes down all the way from months to weeks to days to hours to minutes. All right. And each platform will tell you about that. And then on the x axis, it's all currency. So you pick any pair, like in this case, I've picked up Australian dollar, Canadian dollar. So the y-axis here gives that ratio of Australian dollar, Canadian dollar. So that ratio, how that ratio has changed with time. So we can see that that ratio was somewhere here at certain time x, okay? And then that ratio jumped to a point there at certain time. Then it went down, it went up, it went down, it went up, it went down, okay? Up, down, up. So this is what the market does. It moves up and down. These ratios keep changing. So then, of course, the big question is then how does one make money in Forex? Well, when you make money in Forex by, like I said, you take the value of this X here, okay? If it has increased to the point Y here, you find the difference between Y and X. That is the number of pips you want. So if this is point maybe A and this is point B, the difference is the number of pips you want. And we said pips is nothing but price interest points. That's a measure for movement of currency, regardless of which currency it is. But the value of that pip will vary depending on which currency you're dealing with. Okay? The value of the pips. So you find that in Euro USD, averagely one pip is equal to $10, okay, averagely. Whereas in other currencies, value changes. All right. Okay, so let me pause there. I don't want to give you information overload. Give you a chance to ask a question or two, and then we'll pick up this discussion. Again, I want to give small bites, not a whole lot at once, because previously we just, have long classes. Then we realize some people were left way behind. So that's why I decided to have these smaller sessions, which is not the same as the normal classes we still have, but this is just to help those who are joining late at least have a chance to pick up. So I'm done. Questions? If you have any question, this is your time to ask. And if I don't see any question, then I'll assume that all is well and those who came are benefiting from this.
I have a question.
Yes. Who is this?
My name is Eugene. Eugene.
Eugene. Yes, Eugene.
Yes.
Uh-huh.
So the thing I haven't understood
Yes.
is about the ratio.
The ratio of the currencies.
So yes, what does the ratio help determine?
Okay. The ratio helps determine the value of that pair at that point and time. For example, if you look, I don't know if you can see the right hand side of this currency, it's like 0 point something, but the foreign currencies is normally traded in pairs, right? And each pair comes as a ratio. And the ratio if the ratio increases, the value of that pair decreases and vice versa. You see? So, for example, the more popular one that I can use is the Euro US dollar. The Euro US dollar, let me see if I can write it here. So the Euro US dollar, USD. So this ratio here, take it, I'm assuming at least you did class 4 mathematics, okay? Where this is the numerator, okay, and this is the denominator, all right? So I will have maybe three examples. The first example, let's assume that they have the same value, the euro and the US dollar, i.e. 10 out of 10. 10 out of 10, you divide them, you get, it becomes 1 or 1.0. Okay. Now, example number 2, assume that now the numerator is increasing. So we're saying that the euro is increasing in value where USD remains constant. Okay, so in this second part, we're saying that the top maybe has increased by 5. So instead of 10 out of 10, we have 15 out of 10. So then the value of that ratio will be 1.5. 1.5. Okay, and so on. As long as the euro is increasing and this is constant, these ratios will keep increasing. Okay, and then in the third case, the euro USD is constant and the USD is increasing. So in this case, we have 10 over 15. If you have 10 over 15, over 15, if you divide that, you'll find it's actually less than 1. It's like 0. Okay, mathematicians in the house. What's 10 over 15? So that's 5 by 3, 5 by 2. So it's actually 2 out of 3, which is 20,
6.
0.6. Okay,
Yeah.
0.66 something. So please note that because the USD has increased, okay, and this has remained constant, this number has changed. Now, something interesting here happens. As you play around with the values of these things, the currency can go up and down. Okay, in particular, like in the second part, in the third part, the third example, if the USD, if the numerator remains constant and the value of the USD goes down, then we'll have a similar situation as the second part. It will increase. And all those things make the market go like this, up and down, up and down, down and up and down, and so on. But then the question is, what makes these currencies change in value? Okay, and I'm coming back to answer your question. It is the dynamics, we call them the fundamental dynamics of the world. For example, right now, the US has issues with Corona. And because of that, the US dollar has become very unstable. Anybody who is holding a US dollar wants to get rid of it. So what's happening? The value of the US dollar is actually going down. Why? People feel like the US dollar is unsafe. They don't want to keep their money there. So what is the net effect of the dollar going down? And that's what I was telling you here. Okay? If you have Euro USD and you hold the euro constant, okay, this is 10 out of 10, and you hold this constant. If this goes down, the value of the USD goes down, okay, to 5, what happens? If it's 10 out of 5, suddenly this value jumps to 2.0. Okay? In other words, by the US dollar going down, the value of that ratio has moved from 1.0 to 2.0, just like that. Okay? And what has been happening over the last several months is the value of the dollar has been going down, 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 relatively compared to the value of the USD. Hence, if you look at the chart of Euro USD, it actually has shot up, probably one of the highest it's been in a long, long, long time. So, what does this all mean? It means that the ratio of these currencies is very significant. Very significant. Anything happening to one of the pairs will have an effect on the market, whether it will go up or it will go down. During Brexit, when GBP, all the European currencies, in this case, the euro, the GBP, the Swiss franc, all those European currencies, they were in trouble. So people were running away from them and going to the USD. The USD became a safe haven. USD and Chinese ruble and all that stuff, Chinese currency. But it means in the ratio Euro USD, what is happening? What is happening is the USD in itself, the euro was now going down. If the euro is going down and USD is constant, then what happens? Again, we start from 10 out of 10. If here we have 10 out of 10 and we have 1, then if the value of the euro goes down, instead of 10, we have 5. So we have 5 out of 10. So 5 out of 10 is actually a half. So the value has gone down to 0.5. So in other words, during Brexit, when euro was in trouble, then the whole ratio was in trouble, right? Because the top number was actually going down to 5, then 4, then 3, then 2. So, but 5 out of 10 is a half. So the currency was going down. So I hope I've answered your question. Sorry, I've gone to a lot of detail, but these are called fundamentals that you need to understand. So when the markets are going down, something is happening either to the numerator or the denominator. So that ratio is very significant. And they get affected based on what's happening in the market. Okay. Sawa.
Yes, I have understood.
Okay, good. I'll allow for one more question because I need to jump into another meeting shortly. But the next class, I will pick up from here. Still the basics, the fundamentals. Any other question? Okay. All right. This was a short introduction to Forex, and I'll still build up on this. I'll make it short, 15 minutes, with a bit of Q&A. But the idea then is I want to give people a chance, those who are not there at the beginning, to understand and pick up from there and learn the way we were learning. Otherwise, tomorrow we are back to our regularly scheduled classes. All right. So if you'll allow me, I'll say good night so that I can then jump into my other meeting.
Good night.
All right. Okay, thank you. Eugene and others, Brian, if you have any question, just send it in the platform and I'm sure we shall be able to respond. Thank you.